Hey everyone, welcome back to Corporate Decoder. Today we're diving into Dutch Bros Inc. Its latest annual report, a real treasure trove of information. Get ready because we're going to uncover the story behind their numbers. And let's just say not everything is as buzzy as their drinks. So Dutch Bros Inc. is a pretty big name in the drive. Through beverage world, known for their handcrafted drinks and super fast service. They started way back in 1992 and have really grown into a major player. As of the end of 2025, they had over 1,100 shops across 25 states, which is a huge jump from just a few years ago. They're all about a unique customer experience. What they called the Dutch Bros experience, focusing on speed, quality, and service. Their menu is pretty diverse too, with about half of their sales coming from coffee, a quarter from their Rebel energy drink, and the rest from teas, lemonades, and smoothies. A big part of their strategy is their Dutch Rewards loyalty program. In 2025, a massive 72% of all their transactions came from these rewards members. That is up from 68% the year before, showing how well they're getting customers hooked on a repeat purchase. It is pretty smart because it not only keeps customers coming back, but also gives the company valuable data to understand their buyers better. They're even using this data to personalize offers, which is a key strategy for growth. When we look at their growth, it is clear they're expanding fast. In 2025, they opened 141 new company-operated shops, adding to the 128 they opened the year before. This aggressive expansion is a big part of their story. However, with this rapid growth comes a lot of risk. They're talking about how managing this growth effectively is crucial. And if they don't, it could really hurt their business and their profits. This is something to keep a close eye on as they push into new markets. Let's talk about the money for the year ended the 31st of December 2025. Dutch Bros Inc. brought in a whopping $1.6 billion in revenue. That is a huge increase of almost 28% from the previous year. Their company-operated shops are the main drivers of this, bringing in over $1.5 billion. The growth in their sales, especially from new shops plus a solid increase in what they call same-shop sales, is impressive. Same-shop sales, which basically means sales at shops open for at least 15 months, grew by over 7% for their company-operated stores. Now, while revenues are up, so are costs. Their beverage, food, and packaging costs went up by about 31% compared to 2024. And as a slice of their total sales, these costs also nudged up a bit. This is largely due to higher coffee prices, which they've seen increase significantly. They've tried to offset this with price increases on their menu, but they acknowledge that this could potentially lead to fewer customers. Labor costs are also a major factor. These went up by nearly 29%, and as a percentage of revenue, they held pretty steady. But here is the interesting part: even with wage increases, they managed to decrease labor costs as a percentage of revenue by a small amount thanks to higher sales and productivity. They're really focused on controlling these costs while still growing. Looking at their profitability, the company-operated shop's gross profit margin actually dipped slightly to 21.9% in 2025 from 22.3% in 2024. This small drop, while not huge, is something to watch. It is mainly because of those rising coffee and labor costs, even though they managed to increase prices and sales leverage. It shows that managing these costs is a constant balancing act for them. On the franchising side, things look strong. Their franchising and other gross profit went up by almost 17%, and as a percentage of their franchising revenue, it improved significantly. This segment is doing well, contributing positively to the company's overall financial health. Now, let's look at the behind-the-scenes costs, selling general and administrative expenses. These went up by about 12%. A big chunk of this increase is from investments in their people, like higher performance-based pay and more spending on technology and professional services to support their growing business. They did manage to lower some costs related to restructuring and equity offerings, which is a positive sign that they are streamlining operations. Despite the rising costs, their net income for 2025 was $117 million, a significant jump from just $66 million the year before. This is driven by strong revenue growth, but when you factor in all the costs and expenses, it's important to note that their net income as a percentage of revenue is only about 7.2%. This means for every dollar in sales, only about 7 cents is turning into pure profit. The company also shared their adjusted EBITDA, which is a way to measure their operating performance by excluding certain costs. This number was $302 million in 2025, up from $230 million in 2024. This shows a healthy growth in their core business operations before considering financing, taxes, and accounting adjustments. When it comes to cash, Dutch Bros had about $269 million in cash and cash equivalents at the end of 2025. They seem to have enough cash to cover their immediate needs and future expansion plans. They're investing heavily in new shops. planning to spend between $270 and $290 million on capital expenditures in 2026 alone. This shows a strong commitment to growth. Financially, they also did a big refinancing of their credit facility in May 2025, increasing their borrowing capacity. This is definitely a sign of their expansion needs, but it also means more debt on their books, which always carries risks. Now, let's pivot to the risks they face. Dutch Bros acknowledges a ton of risks, from changing consumer tastes and intense competition to supply chain disruptions and labor costs. They are particularly exposed to the Western United States, where a majority of their shops are located. This concentration means that any downturn or adverse condition in that region could hit them harder than a company with a more spread out footprint. They also highlight the risk of damage to their brand and reputation, which is crucial for their success, especially as they move into new markets where their brand might not be as well known. A really interesting point they make is about their company culture. They believe their people-first culture is a key ingredient to their success and customer loyalty. However, they recognize that maintaining this culture as they grow rapidly and relocate more staff to their Phoenix office presents a significant challenge. If they can't keep that positive culture alive, it could hurt their ability to attract and keep employees and customers. Looking at how their stock has performed, starting from their IPO in September 2021, it has been a bit of a roller coaster. While their stock has generally outperformed the S&P 500 and the Consumer Discretionary Index since their IPO, there have been ups and downs. In 2024 and 2025, their stock saw significant gains, but that volatility is something investors should be aware of. Overall analysis. So, what is my take on Dutch Bros? They're definitely in a high growth phase, and their expansion strategy, especially with their loyalty program and shop openings, is paying off in terms of revenue. They're a strong operator in a booming industry. However, their rapid growth also comes with increased costs, particularly in coffee and labor, and they're facing pressure to maintain profitability margins. The risk of brand dilution or cultural challenges with rapid expansion is also a real concern. They need to nail their expansion plans while keeping their customer experience and unique culture strong. The heavy reliance on consumer discretionary spending also means they're vulnerable to economic shifts. What is your take on these numbers? Do you think Dutch Bros can keep up this pace of growth while managing their costs and culture? Let me know your thoughts in the comments below. If you found this breakdown useful, please hit that like button, it really helps us out. And of course, subscribe for more deep dives into corporate filings just like this one. Don't forget to join our Discord community using the link in the description for more insights and discussions. Thanks for watching, and I'll see you in the next one.